Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Netflix.
And if you find our talks useful, please consider, well, you know the drill. Subscribe, like, and comment underneath.
Oh, today we are unpacking a giant and looking at the recent action. It feels like a genuine mystery.
It really does. It's a classic case of what the market reaction versus the business reality.
It really is. It's one of those situations where if you only look at the stock chart, you think, oh, the company's in trouble.
Right.
But then you look at the balance sheet and it's a completely different story.
Okay, so let's set the scene. We just got the Q4 2025 earnings report. By all the standard metrics, I mean, they crushed it.
We did.
But the stock fell in after-hours trading. So what is going on inside the heads of these traders? Why punish a winner?
It's that classic sell the news dynamic, but with a bit of a twist this time.
Right.
The market had run the stock up, anticipating a great quarter, and they got it a double beat on both earnings and revenue, but then the selling started.
So it wasn't what they did.
No, the reason for the pessimism wasn't what they just did, it was what they said they're going to do next.
The future guidance for 2026.
Precisely. The market interpreted the 2026 guidance as conservative, and Wall Street hates uncertainty. They hate slowing growth rates. But if you actually peel back the layers, which is what we're going to do, that drop might be a massive overreaction.
A discrepancy between market sentiment and what's actually happening in the business.
That's it. Operational reality.
Okay, so before we get to the forecast that spooked everyone, let's establish the baseline. How good was this double beat, really? Because sometimes companies beat expectations that were, already lowered.
No, this was genuinely strong. Revenue came in at $12.05 billion for the quarter. That is up 18% year over year.
18%.
And that beat estimates. Then on the bottom line, the earnings per share, the EPS was 56 cents, and that beat the $1.55 estimate.
Okay, and the subscriber count, because that's usually the headline number everyone obsesses over.
It's massive. They are now sitting at 325 million paid memberships globally.
325 million. Let's just pause on that for a second. Yeah. That's roughly the population of the entire United States, all paying a monthly fee.
Yeah.
That scale is hard to even wrap your head around.
It is. Yeah. And that scale is the foundation for everything else we're going to discuss. But here's the wealth angle. This is why we're talking about this today. That drop in the stock price.
Yeah.
It looks a lot like a capitulation low.
Hold on. Capitulation low.
Wow.
That sounds like trader jargon for trying to catch a falling knife.
It can be.
How do we know this isn't just the start of a longer slide? I mean, usually when a stock drops on good news, it means the market knows something the spreadsheet doesn't.
That's a fair skepticism. It is. But capitulation in this context just means the pessimism is now, it's priced in. The people who are worried about the guidance, they've already sold.
The bad news is out.
The bad news is out. This creates what you'd call an asymmetric risk-reward setup. If the company performs even slightly better than that conservative guidance over the next 6 to 12 months, well, the stock has a lot of room to run because expectations have been reset so low.
So the bar's been lowered, making it easier for them to jump over it later. Okay, I'll buy that for now.
Yeah.
But let's pressure test that guidance. Why did the market think it was so soft?
So for 2026, Netflix is guiding for total revenue between $50.7 billion and $51.7 billion.
Over $50 billion in a single year. That doesn't sound soft to me. That sounds like the GDP of a small country.
In isolation, it's huge. Of course it is. But you've got to look at the rate of change.
Right.
That represents about 12 to 14% growth. In 2025, they grew at 17%. So the market sees that number dropping from 17 to maybe 12, and they just scream deceleration. They worry the high growth days are over.
I see. They see the growth curve flattening out.
Yeah.
But isn't that inevitable? You can't grow at 20% forever when you already have 325 million users.
Exactly.
At some point, you run out of humans with internet access.
That's the law of large numbers. But management is calling this solid growth. And frankly, growing a $50 billion business by double digits is incredibly hard.
It's a huge accomplishment.
It is. But here's the pivot. This is what the bears are missing. The real story here isn't just about getting bigger. It's about getting more profitable. This is the margin expansion story.
So they're transitioning from that growth startup mentality to more of a cash cow efficiency machine.
That's the perfect way to frame it. They are targeting a 31.5% operating margin for 2026.
Okay.
That is an expansion of about 2.5 percentage points compared to last year. They expect operating income to hit $16.1 billion.
Okay, explain that to me like I'm 5. Why does a 2.5% margin increase? Why does that matter so much?
It matters because of operating leverage. It means for every extra dollar they bring in, they don't have to spend a full dollar to get it.
Their costs are more fixed.
Their costs are relatively fixed, the content's already made, the servers are running. So as revenue grows, a huge chunk of that just drops straight to the bottom line. Operating income is expected to be up 21%, even if revenue growth is slowing.
That is a crucial distinction. Revenue's slowing, but profit is growing faster.
Yeah.
And where is this growth coming from? Is it just them raising prices in the U.S.? Because I feel like every time I open my email, there's another price hike notification.
That's a common perception, but the data shows it's much healthier than that. This isn't just a U.S. story anymore.
Oh.
We are seeing double-digit growth everywhere. North America is accelerating, yes, but so is EMEA, Europe, Middle East, Africa, and we're seeing continued growth in Latin America and the Asia-Pacific region.
So it's a balanced attack. It's not one region carrying the whole team.
Correct. And backing all of this up is what we call a fortress balance sheet.
I love that term. It sounds impenetrable. But what does it actually look like?
It looks like $9.03 billion in cash just sitting in the bank. Their debt is very manageable against that. And because they are generating so much cash, more than they need to run the business, they're giving it back to shareholders. They bought back 18.9 million shares recently.
Wow.
That's $2.1 billion worth of stock.
A $2 billion buyback is. That's aggressive. It tells me they aren't finding better places to deploy that cash. Well, aside from the one we'll talk about in a minute.
Right.
And no major holes in the business to patch. They're signaling that the best ROI right now is their own equity.
Exactly. It shows huge insider conviction. They wouldn't be spending $2.1 billion on their own shares if they thought the business was about to fall off a cliff, you know? It puts a floor under the stock price.
Okay, so the core business is solid, profitable, and global. But investors always want to know, where's the new money coming from? Let's talk about the growth levers. I keep hearing about the ad tier, but is it actually working?
The ad tier is absolutely critical. This is the new engine. In 2025, ad revenue, it exploded. It hit $1.5 billion. That is up 2.5 times year over year.
$1.5 billion is nothing to sneeze at, but for a company making $50 billion, is it really moving the needle? It's like 3% of their revenue.
It is right now, but look at the trajectory. They expect that number to double again to roughly $3 billion in 2026.
Double again.
And the tech behind it is getting significantly better. By Q2 of 2026, they are launching proprietary modular interactive video ads globally.
Modular interactive video ads. That sounds like marketing bingo.
Yeah.
What does that actually look like for me sitting on my couch? Is it just a QR code popping up?
It's much more sophisticated. So think of it this way. You're watching a cooking show, maybe Chef's Table.
Right.
A modular ad doesn't just show a generic blender. It pulls data to show where you can buy that blender locally or lets you click to add the recipe ingredients to your shopping list right there on the screen. It moves the ad from awareness to conversion.
So it makes the ad shoppable.
Exactly. And advertisers pay a premium, sometimes 30 to 40% more, for that kind of interactivity because it's measurable. They're building a moat around their advertising data just like they did with their content.
Okay, ads are scaling. Then there's gaming. I feel like for a long time, Netflix games were just there, like a weird icon on your phone you ignored. Is that changing?
It is changing. It's moving from an experiment to a lock-in mechanism. The goal isn't necessarily to sell games like Xbox or PlayStation. It's to increase the lifetime value of a subscriber.
The sticky factor.
Right. If you're playing a game on Netflix, you are less likely to cancel your subscription. And they've had real success with big titles. They brought on Red Dead Redemption and Grand Theft Auto.
Oh, wow. Those are serious games. Those aren't just mobile puzzles.
They are massive franchises. And they're launching a reimagined FIFA football game, plus party games like Pictionary, which are showing really high reach. About 10% of eligible members are engaging. It just keeps people in the ecosystem.
You unsubscribe, you lose your saved game. That's a powerful psychological hook.
Exactly. You come for the movies, stay for the games.
Now we have to talk about the elephant in the room. The rumor, well, not even rumor anymore, the announcement. The mega catalyst. Warner Bros. Discovery.
This is the biggest potential mover on the board. Netflix has announced an all-cash acquisition of Warner Bros. Discovery.
That is massive. We are talking about merging the biggest streamer with one of the most historic studios in Hollywood. But walk me through the logic. Mergers this size, they often turn into disasters. Why does this one make sense?
It's a game changer because of the financial mechanics. Think about the strategic value. Synergy number one is obviously the content library.
Sure.
You get access to everything Warner Bros. Has ever made, Harry Potter, DC Comics, Friends, Game of Thrones. The depth of that catalog is unmatched.
Right. Having Batman is cool. But does it justify the price tag?
It's not just about having Batman on the menu. It's about the cost basis. Right now, Netflix pays huge licensing fees for that content. If you own the IP, those licensing costs, they vanish from the expense line and turn into assets on the balance sheet. It completely changes the unit economics of the library.
That's a really smart point. You stop renting the house and finally buy it.
Yeah.
So your monthly payments disappear.
Exactly. And synergy number two, the integration of HBO Max. This allows for incredibly personalized subscription tiers. You can bundle high-prestige HBO content with the broad appeal of Netflix.
Which gives them pricing power.
Huge pricing power. You can charge a premium tier that includes everything, which drives that average revenue per user metric higher.
When does this actually happen? Because deals this big take time, and regulators love to get involved.
The deal is likely closing in the first half of 2026, and this is key. I think the market is underappreciating this because it hasn't closed yet. It's a multi-year catalyst. Once they start integrating those libraries and optimizing costs, the margin expansion could be even bigger than what they're guiding for now.
So the market is looking at the slowdown in organic growth, but ignoring the rocket fuel that's about to be added to the tank via this acquisition.
That's a great way to put it.
However, we have to be balanced here. We can't just paint a rosy picture. Let's play devil's advocate. What is the bear case? Why would someone not buy Netflix right now?
The bear case revolves around that deceleration we mentioned at the start. The argument is the high growth phase over? They've already cracked down on password sharing. That was a huge one-time boost. Now they're moving from high growth to slower growth, settling into the mid-teens.
And if they're just a utility company now, like a digital cable provider, maybe they shouldn't command such a high stock price multiple.
Right. Valuation compression is a real risk. And then you have the macro factors, external pressures. We have trade tensions, rising bond yields, general market caution. When the broader market gets stared, high-tech stocks often get hit first.
What about the recession argument? If the economy tanks, isn't Netflix the first thing people cancel?
That's the fear, but I would argue, and this is the mitigation, that Netflix is actually quite resilient. It's a recurring subscription. It's relatively cheap entertainment compared to going out for dinner or a movie.
Sure.
In a recession, people stay home more. It's less sensitive to economic cycles than, say, a pure advertising company that relies entirely on marketing budgets.
It's the stay-at-home stock.
Yeah.
Even in a recession, you need to watch something to distract yourself.
Exactly. And honestly, who cancels Netflix first? You usually cancel the third or fourth streaming service you have, the niche ones. Netflix is usually the default utility.
Right.
And with that cash pile, they can weather a storm better than almost anyone else in media.
So let's bring it to a verdict. We've looked at the numbers, the growth engines like ads and gaming, the massive Warner Bros. Acquisition, and the risks. What's the score?
I'm giving this a bullish score of 7.5 out of 10.
7.5. That's solid. Not a screaming, sell the house and buy, but very constructive. So what's the strategy for the listener?
I think the best time frame here is a 6 to 12-month hold. This isn't necessarily a day trade.
Okay, 6 to 12 months. Why that specific window?
Because there's a potential swing trade opportunity right now. We're looking at the Q1 2026 earnings coming up in April. I suspect the market will realize that the guidance was too conservative. If they beat that, you could see a nice pop.
So buy the fear now, wait for the reality check in April.
Yes. And longer term, you're betting on that margin expansion and the successful integration of Warner Bros.
Can you give us the elevator pitch? If I'm in an elevator with a skeptical investor, why am I pitching Netflix?
Here it is. Netflix is a cash-generative machine with a fortress balance sheet. It is currently trading at a discount because of temporary caution about guidance, but it has massive upside coming from its exploding ad business and the acquisition of Warner Bros. Discovery. You are buying a market leader at a discount.
I love it. Cash machine, fortress balance sheet, trading at a discount. That is a compelling narrative.
It really is. And before we go, I want to leave you with one final thought that really puts their dominance into perspective.
Let's hear it.
We talk about how much they spend on content, right? Billions. But here's the efficiency metric. Netflix is spending about $1.10 in cash for every $1 of content expense amortized.
Okay, unpack that one last time. Why does that ratio matter?
It shows incredible discipline and efficiency. But more importantly, think about their scale relative to competitors. Most legacy media companies are spending $1 to get maybe 80 cents back right now as they try to build their streaming services.
Mm.
Netflix is spending $1 to get $1.10.
So they're winning on the math.
They're winning on the math. They have over 300 million subscribers to spread that cost over. It leaves you with one question. In a world when Netflix spends $1 to get $1.10 of value and everyone else is burning cash just to keep up, is there actually a streaming war anymore?
Or are we just watching the victory lap?
That's it.
It's a powerful place to end. They have won the war of scale, and now they are just optimizing the victory. Thanks for listening.
See you next time.